it's time that we kick off. And I'll say welcome to another edition of RedeConnect, our now kind of annual and pretty big conference, and also now the Climate and Impact webinar, which I suppose for this session, we've historically alternated it year on year between having LPs one day and GPs the next year. But I suppose in a moment, let's be honest, of some challenge and also probably, to be frank, a little skepticism, it kind of felt appropriate that if the GPs are the evangelists in this space, that we should probably have the congregation and let the LPs speak. And I think because this session really has been centered historically on our annual climate and impact paper that we produce after speaking to a ton of LPs. And it's always been a really great opportunity, frankly, for us to showcase our dedicated specialism within these themes. But I think, as my colleague, or Rede Fearless leader Adam Turtle said, there is an elephant in the room for this segment right now, because the geopolitics around climate have changed. But as Adam also noted, it's not all doom and gloom. And we're in a moment, maybe to quote Ban Ki-moon, where the golden thread of energy has really come to the fore. And as he said, it connects economic growth, social equity, and environmental sustainability. Technological progress, too, is transforming what's possible with everything from battery storage to electrification. And an increasingly complex world that makes supply chains, resourcing, and security challenges more acute than ever. And so, with all of that there, the exam question that is before us is where now for climate and impact. And to do that, I've got a pretty awesome panel, which I've got to say I'm pretty excited about, and to thank them again for joining me. And maybe we'll go around and let them introduce themselves. And Bill, maybe start with you, a little context on yourself.
Of course, and thank you for having me, Etienne. I'm Bill Oram. I am a partner at Capricorn Investment Group. It is a company that we started over 20 years ago to focus on diversified climate and impact investment management. Today, the business is really split into two parts. So we have an advisory business in which we work with mission-driven families and foundations, and we integrate climate and impact throughout the portfolio. Then we also have a GP stakes business in which we provide growth capital, catalytic capital to new and established asset management companies also focused on climate and impact.
Thanks, Bill. Anya, you want to jump in next?
Sure. Hi, everyone. Thank you, Etienne. So I'm Anya Maintik. I'm a partner at Mercer Alternatives. I look after our European and impact investment activities when it comes to private equity. So our business is divided really into two parts. So we invest both on behalf of ourselves. We have our own impact dedicated vehicles, and we also advise clients on their impact investing activities. So we run some mandates on that side. And that's really it.
Awesome. Thank you, Anya. And last but not least, John.
Hi, and thanks for having. So John Goldstein, I head sustainability for Goldman Sachs's asset and wealth management business. So I got there via a slightly scenic route. So I co-founded Imprint Capital back in 2007, joined Goldman when they made the surprising suggestion in 2015 that they'd rather buy us than become a client. And then spent my first 4 years in the asset management business. Then I got kicked upstairs to work with one really interesting client called Goldman Sachs. I moved to the executive office and launched a group called the Sustainable Finance Group, working with our leadership and board on sustainability strategy across our different businesses. And then I came back to asset and wealth and really work across our different types of clients, large institutions around the world, pension sovereigns, insurers, kind of you name it, family offices and ultra high net worth, and then our distribution partners to help them navigate this landscape and build portfolios across public and private markets that hopefully deliver on their expectations, aspirations, and requirements.
Awesome. Thank you all. Well, look, we'll get into it. Maybe some quick housekeeping around those to say that we've got a chat function here. So if people have questions, do feel free to put them in, and we'll keep time at the end so that we can touch on some of those. But let's just get to it. And given the three of you, you all hold pretty privileged seats, and you're still here and still talking about climate and impact. I'm curious what underpins your sustained conviction in the space, and maybe Anya, I'll start with you if I may.
Sure. I think our conviction has always been to a large extent driven by the business case. We are financial first investors, and most of our clients are also looking for that financial return. So I think, we've obviously had an ethical, let's say philosophical interest, but I think it's fair to say that we would not be here if we did not believe that it was also possible to actually generate financial returns. And I think we've faced, I think, many ups and downs on our impact and sustainability journey. I think that's fair to say. What keeps us still here is the fact that we do believe that there is a genuine business case. That for a lot of sectors in the economy, a lot of companies, I think impact actually does work and does provide a certain solution, whether that's decreasing costs, whether that's managing risks, whether it's regulatory challenges, managing rising energy needs, whatever it might be. I think that's the reason why we are still looking at the sector and still committing to it. So I think we're looking. Really, I would say we've definitely become more selective. We were always very selective, but I think we're even more selective with the benefit of time. But we are really looking to find those situations where impact is somehow embedded in the business model. So rather than just purely, impact for impact's sake, we are trying to steer clear of.
Appreciate that. And yeah, maybe I think it's a good question for us to kind of for everyone to give some perspective here. John, I don't know if you want to jump in next and speak to the conviction you will have and the many different ways, I suppose, that you play it.
Yeah, look, I mean, this is part of what I spent a lot of time back in the acquisition and then working with our leadership back in 2019 and developing strategy. And I don't think much has changed, right? At the end of the day, I think what we saw was a diverse, persistent, interrelated set of drivers underlying 9 growth themes in the real economy, right? And navigating growth themes in the real economy and their ups and downs and the risks and opportunities, that's what a firm like ours does. Above and beyond that, some clients had a particular focus in these issues. So real drivers in the real economy that drove relevance across a variety of types of investments. And for some, it was risk. For others, it was growth. For others, it was an operational issue. And then clients who in some cases had much more specific things they wanted to pursue. But I think, as Anya said, overwhelmingly really a fiduciary perspective, delivering on returns for shareholders, for pensioners, for others, but navigating these new emerging growth themes, which is really the job for any investor like us.
Nice. Much agree. And Bill, maybe just touch and give you the opportunity as well.
Yeah, and I'll kind of flip back and forth between maybe the LP perspective and then the GP perspective, just given we think about it in both ways. But to us, it's certainly the business case, the economic imperative. But from a portfolio context, what we've always found interesting about climate is it's one of these interesting segments in which the TAM, of course, is extraordinarily large, right? This is perhaps the largest capital expenditure program of our collective lifetimes. The duration of that is extraordinarily long as well. Yet there's a lot of specialization that is required to execute on it. And so if you kind of think about where alpha resides, it's often in very specialized strategies. The issue with most specialized strategies is they tend to be very narrow in scope. So you develop all sorts of competency and expertise, but if you're an allocator, you can only deploy it in a relatively small area of a portfolio, right? So there's a trade-off between resources allocated and spent and how much P&L you can generate. And what we've always found super interesting about climate is because it's decentralized and distributed, you have these wonderful characteristics around where specialization can create value, but you almost have unlimited TAM and duration for how you can deploy that, right? So that's a very good use of an allocator's time to develop competency in those areas. So that is, that's that's a, kind of a endowment, framework that we've often thought about as to why, irrespective of the mission and the values orientation, that it's actually a very suitable and relevant area for many long duration portfolios to focus on.
Just the one other thing I would add at the end, I think in a way that I arguably is newer beyond, I think, what Bill laid out, it's also sort of unavoidable, right? I think if I knew more about science, there's probably some notion of constructive entanglement of atoms, right? And as we look at the growth of things like kind of AI and data centers, the biggest issue they're all wrestling with is energy. Increasingly, they're looking at water. They're looking at a whole host of issues. And then as we have complexity geopolitically in terms of an evolving landscape, the security of supply, resources, all of these things become so intertwined that whether a client overtly started looking at these thematics or not, it's not that long before you start bumping into them, whether you started on that journey or not.
I think I mean, totally agree on that. And I suppose maybe also goes to this point of this market, when we were evangelizing about these things, maybe kind of 10 years ago, there was a lot of people who came into the space looking for that momentum. There were broader challenges within private markets. And we're probably now at a moment where there's quite a lot more proof, I feel. And I'm curious, John, maybe to the GPs, you obviously backed a lot of these GPs early. As you think to what liquidity has looked like, as recognizing this is a challenge for lots of private equity, private markets, how does liquidity look like in this space?
Yeah, I mean, I think that part of a sign of how this has all grown is the notion of this space is a rather large, complicated tent with different subdivisions within it. And so I think the answer is the gloriously specific, it depends, right? And I think in some cases, it's not dissimilar to sort of the regular way sub-asset classes. In other cases, it may be a little different, right? Which is, venture has been hard because there are some sectors that have had a lot more exits, and the power laws of venture have above and beyond. I think people talk about capital intensity, but I'd say, when we do the analysis, actually, just the power law dynamics of venture have made it a little hard, particularly on the climate side for a period of time. I think we see really interesting opportunities and a little more liquidity in this kind of lower middle market, small buyout space, particularly if you're able to provide the operating resources that those companies often need to grow and to succeed. But then as we get to other asset classes, I think we've seen a really interesting opportunity in private credit. That regular way market has grown, but there's a specialized area where there's a significant imbalance because over the last 10 years, over $750 billion of sustainable private equity was raised against about $61 billion of sustainable private debt. And that imbalance is partially fed by the fact it takes real specialization, it takes real relationships, it takes real expertise. And against that backdrop, you can generate, current cash pay, you can generate, transactions that will actually, amortize, pay you down. You can get kind of money out, money in. And I think that's an area that's been quite interesting and is, I think, going to continue to be interesting for the near term. And then in infrastructure, I think particularly as we look in more the middle market space, as we get into core plus or even value add, I think on two fronts. I think number one, at a certain asset size, there aren't that many takeouts for very, very large assets. And there has been a relative concentration of infrastructure capital in extremely large funds. Somebody quoted me a statistic the other day that was something like 45% of all infra capital in 2023 was raised by 3 funds, right? At that point, liquidity and exits get hard because there aren't that many markets for a small number of assets that are that large. But as you get much more to kind of middle market, kind of core plus value add, number one, there are more pathways to exit. And I think we have seen over time a real difference in DPI in these different segments by size. And then I think particularly on the thematic front, I think we've seen things go through this market maturity curve from kind of early nascent to emergent to mature, right? And I think in that, if you can find things in emergent space when they've been de-risked, but aren't yet flooded with capital, that's been a really interesting space to invest on the infrastructure front, because as that proves out, there are ready markets for those platforms and those assets. Back to your point about liquidity, and so I think you pretty quickly go from a general question about liquidity to much more specific pieces, not just on asset classes but on sub asset classes.
No, I agree with that. And I think maybe rather me be the mouthpiece for it, Bill, I'll hand to you on this piece of like, because this also plays into the attractive segments of, where do people want to play? Because I think there are some of the themes, frankly, that John touched on there where we partnered on things, and curious maybe of your perspectives on the most attractive segments and sub-segments as you see it to be playing in.
Yeah, and maybe before I kind of talk about specific, areas of new deployment, the context around, this discussion, of course, is, this challenging environment for climate, and I think we all appreciate that to some degree. But I think what John and Anya outlined, I agree with, which is, as there's been more focus on, security, independence, affordability, reliability, people start to create this Venn diagram that, implies the market is more narrow. And I think it's actually kind of worked in the opposite way, which is it's crowded in more traditional and mainstream infrastructure, industrial investors. And so, we're seeing this just, the thematic around decarbonization, adaptation being expressed across a much broader swath of the private markets. And so I think that plays into liquidity, and also now this idea of where specialists can have advantaged positions, and I do think that there are segments which remain fundamentally undercapitalized and where specialization is required. I think areas related to the circular economy. I mean, we're seeing that really grow, and it actually ties in very nicely with what John said, because that oftentimes is expressed in a lower middle market context. We're certainly seeing agriculture, right, as another segment, which is, again, fundamentally undercapitalized. You think about agriculture, 30% of global GDP, 20% plus of emissions. And if you think about how much of private markets are allocated to ag, it's de minimis, right? And it's because of the fragmented and decentralized nature of it. But again, that creates opportunities. I think anything related to grid adjacency and electrification and storage, of course, like those are highly attractive and scalable segments. So those would be, I think there's I'm sure we all have a long list of attractive segments. Etienne, you probably have your own, but those would be 3 or 4 that are certainly top of mind for us, both as a potential GP investor, but also as an allocator, just because we see supply and demand mismatches.
Yeah, and definitely have a few that spring to mind. And I suppose maybe where my head goes from here is speaking to all that complexity, speaking to the increasing specialization. Is there as much space, I suppose, for the new entrants? Because it felt like there was a real groundswell of them at one point, and there's probably less now, and the bar is higher. So maybe, Anya, to ask you the question: what do new entrants need to look like in order to succeed in the market right now? And I'll let you pick your segment, recognizing that that's a very, very broad question. Anya?
Sorry, was that for me?
Yeah, for you, sorry.
Yeah, sure. New entrants. Look, I think I would actually disagree maybe with the fact that the market has matured that much. Yes, it is obviously more mature than it was 5 years ago, but I think if you compare it with some of the other private market asset classes, then I think we still have a very long way to go. I think we're only, in a way, I think we're only at the beginning of that trajectory. There are a handful of GPs who maybe have, 2, 3 vintages and maybe the beginnings of a track record emerging. So I would actually say the field is wide open. What it's maybe, I think it's open for certain types of GPs, is how I would qualify that. I think it's open for GPs who have some sort of genuine differentiation to bring, whether that's maybe through specific sector expertise, industrial knowledge from maybe previous lifetimes, access, execution capability, I think maybe where the market is less open, or certainly from our perspective, is more the opportunistic play. I think that we have 5 other strategies on the platform. What we don't have is an impact strategy, and it's a popular topic from a fundraising perspective. So I think we should launch an impact strategy. I think part of the market correction that we're seeing anyway from a fundraising perspective will make those moves more difficult. But I think also I would say the market has maybe moved on a little bit from that. I think both John and Bill mentioned the increased role and the increased need for specialization. And I think that's really where the new entrants need to have some sort of shade of specialization to really, to stand a chance and to be successful from a fundraising perspective.
Maybe on that question, Bill, I'll hand that to you as well. Here's your perspective, particularly, I suppose, given the fact that you play both roles, both as a GP staker, but also I think as an LP.
Yeah, look, sometimes we talk about climate and this thematic as it's fundamentally different from all the other segments of the private markets, right? But it in many ways it's the same, right? And if you look at the asset management kind of industry within climate, it remains incredibly barbelled, right? You have this long tail of relatively small, subscale kind of early stage managers, and then you have these large, very large, very capable platforms. And our one of our beliefs, right, and theories is that is not a equilibrium or a stable structure, in the same way that it's not how any other industry or asset class has evolved. Over time, there's going to be a filling in of these middle market, operationally intensive, specialized strategies that take the early stage businesses or the family-owned businesses, the founder-led businesses, they professionalize, commercialize, grow them, and they create different ways for value creation, or different pathways for value creation to some of the larger, more established platforms. And I think the rationale for that and the opportunity set is equally, if not more, robust within climate. So again, if you kind of look at the industry, if you think about climate asset management as an industry, the structure remains still imbalanced. And it doesn't, I think we're past the point in a good way of anyone being able to start one of these firms. But I don't think we're terribly pessimistic about the ability of new entrants or emerging entrants to take share and play a very vital role in climate across each of the sub segments, because it's really still greenfield.
I would just chime in 2 little things. I think one is track record, right? I think it doesn't. First time funds are fine. First time investors, I think, are a little harder, right? And I think we do see some great teams spinning out of firms who have good proven track records as investors, who are starting their own funds. I know, Bill, you've got a lot of experience in that space. But I think back to kind of what's important, I think having a good track record people can point to of success, whether it's in the same fund at the same institution or not, a real track record is critical. And I think second of all, it's a little bit of kind of horses for courses, right? People have asked, I remember I was at the gym, like, what's the model? Is it big firms adding this? Is it small specialists? Is it spin outs? Is it this? Is it that? And it's like, yes. Right. The reality is there's a space for a range of these different groups, but I think some are better suited to some of the subsegments, right? I think, Bill, your point, which is if you're in that lower middle market family-owned business, you better have those value acceleration resources to be able to really, really do the work, right? Because you get 2 reasons the valuations in that segment are attractive. One is supply-demand dynamics, a lot of unbanked proprietary deals without as much competition, but one is there's real work to do. You got to be able to roll up the sleeves and add that value. For something like credit, there's a infrastructure and platform side of it to source, to originate, to execute, like that's really, really important that may be harder with newer, smaller platforms, right? I think just different asset classes may be suited, with different infrastructure requirements as well. I think so. Those are the two points, kind of this horses for courses, and first time fund, yes. First time investor, less so.
Definitely, yeah, agree with lots of that. I mean, I'm where my mind is going. A question maybe we've not touched on the context here is maybe geography as relates to some of these. I think there's been quite a bit of conversation around US versus European opportunity sets. I'm curious, I suppose, how this group thinks about that, and thinks through that challenge in the current environment. Anya, very well, welcome for you to take this one, if you fancy it.
Sure. I'll try not to say anything too controversial politically. No, I think, look, what we found actually is whereas our strategy is to have very much balanced portfolios across the geographies or across I would say across the developed markets from a European and US perspective. But the reality is we do lean towards Europe, and most of our impact portfolios, both for our vehicles but also for our clients, tend to be more European than US. I would not say majority, but I would say definitely more European than US. But that's also partly driven by the regulatory requirements, right? And the fact that we have, we do often need the SFDR reporting requirements, et cetera, which not all US funds meet, which makes perfect sense. So we are constrained from that perspective. But I feel that especially at the sort of maybe lower mid-market to mid buyout stage, I do feel that there have been more opportunities in Europe. I think maybe the VC ecosystem in the US is richer on the impact side and on the climate side than in Europe. But I will leave Bill to address that because I think he's much more familiar with that part of the market than I am. But that's, I think, yeah, to us sitting in Europe, that feels like you definitely have way more opportunities in the US there than we do. But on the buyout side, I feel that, yeah, the market has more opportunities with longer track records and maybe more convincing GPs on the European side, in general, in terms of pure numbers.
Yeah, no, interesting.
We are striving for
Yeah.
balance, right? To the extent possible.
Yeah.
But yeah, with the constraints, then honestly, the regulatory side is a meaningful constraint for us as well.
Yeah, appreciate that. And thank you. And yeah, I suppose we're getting at that in slightly a context of, we've been so focused on, with my climate, talking about decarbonization to go that layer deeper. But it feels as well like we're also in a moment where we're going beyond those opportunities. And I think, in differing ways, each of you touched on things like supply chain resilience, adaptation, AI-related energy demand. How, I suppose, do you think about that, if those segments evolving, and the kind of constellation of GPs evolving into those segments? Do you see specialization within those, and how do you see people approaching it? Bill or John, happy for either of you to take that.
I do think that areas related to resource efficiency, circularity, adaptation, biodiversity, nature-based solutions, and natural capital, those are probably a bit more open for new entrants, just because there is so few kind of limited so few incumbents. And it is an area that, again, we're actively spending time looking at, both from a GP as well as an LP segment, because we think these are areas that reward specialization. Obviously, when you get into nature-based solutions, you get into agriculture, you start to have much more of a global orientation. Certainly, if we're talking about authentic impact, and so that that's where we're looking quite a bit. coming back to Anya's point on geography, I think from a GP perspective, obviously one of the challenges is as a U.S. manager or a partial owner of U.S. managers is how do you engage with European allocators, right? Because I do think what Anya outlined is very much what we hear and we see from European allocators. So I think business planning, capital formation has to account for the fact that the bar had maybe gotten too low for global flows into the US, right? Where it seemed like there was almost unlimited demand, and that's reversed quite strongly generally, but certainly within climate, and that is something that we're actively accounting for in in our business planning.
Appreciate that. And I think where my mind goes here is we've obviously quite climate heavy, right? And I remember having a conversation with some of your colleagues, Bill, of using a huge amount within the social ecosystem, but it feels like that gets a lot less airtime. Is that being held back? And if it is, why do you think that is? Or maybe you think I'm off base, but curious of your perspectives there. Again, noting that social is quite broad. So we'll leave you to some specificity.
Is that a question for
You,
me?
yeah, Bill, yeah. What's
Yeah.
holding social back? Yeah.
Look, I think I'm going to dodge the question to some degree, so forgive me. Look, I think one of the issues or characteristics that's come out of the last few years is the intersectionality around a number of these issue areas, right? I think John said it up front, right? It's very difficult to disentangle, climate impacts and accounting for that in a portfolio with also not accounting for some of the social, impacts, particularly around the most vulnerable communities. So to us, these are strongly, linked and interrelated. And so we're expressing that again as an allocator, thinking about, not climate justice in the historical, sense, but certainly thinking about, where is resilience and adaptation, kind of most important and most fundamental to economic sustainability. And so I think that social aspect is a critical element, and it's certainly a critical element as it relates to nature-based solutions and biodiversity, right? I think where a lot of the voluntary carbon markets have been challenged is just not being able to holistically account for the impacts, right? Not just the environmental, but the social and economic impacts of kind of the local stakeholders. As it relates to kind of social outside of climate, yeah, I mean, I do think that if you look at the flows, I mean, John, you may have a better sense. I think climate, because of what's happening with AI, electrification, and just the mainstreaming of demand has, I imagine it started to significantly outpace some of these other segments, at least in the last couple of years.
Yeah. I mean, I can chime in a little bit. I think two things I see on the social side. I think one is, I think a lot of investors haven't necessarily done the work to really understand the development of that market and the underlying sort of business models, right? And I think some of it's because it's changed, right? As you have, propagation of technology, I think what you see is increasingly businesses that can be formed to tackle kind of what they call the iron triangle. It's a term that comes from healthcare, but you can apply it to education as well, which is the question is, how can you improve quality and impact, lower costs, and expand access, right? And sometimes there are business models that improve quality but really raise cost. Just how do you actually do all those? And I think we are increasingly seeing these kind of technology enabled service models that actually do just that, right? The core business is driving better outcomes at less cost for more people. But those are newer businesses in education, health. There's a lot of technical detail in how those sectors work, say in the US, reimbursement, regulation, policy. And so I think some of it is just some investors aren't as close to it, which ironically is what creates some of the investment opportunity, right? There is a moat in terms of expertise and access that means you can buy businesses that with just basic like SaaS metrics look very, very attractive. But there is this barrier to entry from a knowledge. So I think some of it is some folks just aren't as familiar with those segments, those business models. I think two is sometimes folks that are maybe less commercially focused but have more of an impact lens. When they think social, they get very specific geography, population issue in a way that is very hard to match with how a GP kind of sees the investable universe. And so that's sometimes what we'll see is a little bit of, I wish the world would give me X, this intervention, this population, this geography. And so sometimes on the social side, there is a mismatch between what folks would love to see in the market and what exists in the market. So those are the two things I guess I would say that I observe.
Thanks very much, John. I agree with lots of that. I mean, I wonder before, I should be mindful of keeping time for questions. Anya, is there anything on that piece that you would like to include as well?
I think I would just concur with John in the sense that that definition of social and impact can be a lot more problematic and just tends to be a lot more almost investor specific. So, the definition of what exactly is impact in a healthcare investment or in an education investment sometimes causes, it's very polemical. It's there's a big debate often around is this investment really really impactful, or are we just funding a great private chain of hospitals, right? So I think that sometimes makes that space also more complicated. And often, I think, as John said, clients are often, when it comes to social, a lot of people are looking for more local impact. Whereas in the climate theme, they're happier to have this global point of view and this really much more global approach. For the social impact, there's a much bigger focus on local impact, which is obviously quite hard to then match with potential investment opportunities sometimes. So I think that's just what I would add on that topic.
Agree with that, and I appreciate you giving that detail. I think that we're obviously mindful here a bit of time, and maybe a last round robin question to each of you in turn to give maybe some perspective on your confidence level in the successful deployment of your portfolios over the next 12, 24 months, and the confidence level you have in the quality opportunities that you're seeing. Bill, I don't know if you'd like to start.
Yeah, look, on the GP stakes side, I think the bar is actually quite high because visibility into capital formation is today a bit more mixed, right? So I think the bar is always high, but I think given where we are in the cycle and waiting to see some realizations and completed track records, as well as just some of this overhang, has created high bar. But that's a bit specific to how we think about growing some of these organizations. As a allocator, I think it's quite high, right? And I think John mentioned private credit, right? You see what's happening in private credit in traditional markets, and you compare that to other forms of asset-based finance in climate, and I think there's a very attractive spread that exists there. I think some of the opportunities in e-waste, battery storage, circularity, those we have a high degree of conviction in our ability to deploy capital. We've gone through the whole discussion without mentioning the missing middle, I think, which is kind of shocking to me. So I'll kind of ruin it for everyone.
I think. Yeah.
But look, we do think that a lot of these early stage technologies have advanced and been de-risked to some degree, yet the overhang is creating very attractive entry points, whether that be through equity or debt. And I therefore think that we'll have a fair amount of capital deployed into that quote unquote missing middle in the next 12 to 24 months.
Thank you, Bill. I think we actually had this question come in as well of someone maybe sharpening it slightly and saying, wanting to know the most exciting places to be investing over the next year or so. John, maybe I'll go to you next and for you to give your perspective here.
Sure, I'll be brief, but I can point people. The long form version of our answer to this is actually on our website. So you can search for my name and checks you and Goldman Sachs Asset Management. And we actually worked really hard to publish a lot of our research and findings on these questions, because these are topics that a lot of investors are looking for guidance and perspectives. And I think beyond, traveling around the world and sitting in rooms with, boards, investment committees, CIOs, finding ways to make it more accessible. If you can't find it, just send me an email or hit me up on LinkedIn and I'll send it to you guys. But broadly speaking, look, I think, what we try to do is have just a basic set of principles to navigate and how that matches to asset classes, because you need kind of a compass, right? If the seas are moving around and very dynamic, you need a compass to know where you're going. And so these kind of 4 core principles: number one, we see a decoupling of the growth rates in different thematics. Broadly speaking, some of this maps to electrons versus molecules. We see some going faster with volume in that virtuous cycle of volume lowers cost, drives volume, lowers cost. Some are slowing down, and you get adjacencies to themes like AI of kind of, can I get those secondary, tertiary effects? But find a line that's going up, not a line that's flat or going down. 2 is the days of the green premium may be gone, right? Companies want to pay less, not more, greater security of supply, greater quality, lower cost. And you need a value proposition that is evergreen, robust, and resilient across macro and policy issues and cycles. Number 3, being very deliberate about where to be in the value chain. Right, front end of value chains are often commodities. The tail end are very often competitive, margin compressed end markets. So that kind of picks and shovels middleware space is often very interesting. And finally, being very sensitive to the supply demand of capital, because those first 3 points can give you your conviction. That 4th point gives you your margin of safety. Right. And so we talked about that lower middle market on private equity. We talked about this kind of, middle market, more core plus value add on infra relative to core. And I think private credit is where that imbalance is really significant. So that kind of how you have some principles that get conviction and you use supply demand dynamics to give you margin of safety. I think those have been useful guides that I think we'll continue to use going forward. I think the last thing is having context is really, really helpful, both with how Imprint works in allocating externally and even how our own investors work. This both and structure of having dedicated teams with deep expertise, specialization, history that know these markets inside and out, and people that see the whole rest of the universe as part of the process, right? Because people say, do you have a separate team? Do you integrate it? And once again, the answer is yes. And I think that's to navigate this, to find the best opportunities and to really know if they pass muster. Bill talked about where the bar is, to keep the bar where it needs to be and make sure no one's squinting with green colored glasses. You need both people plowing those markets who know them really well and people that see the whole rest of the world and having those groups work together. So that would be the 2 cents. The long form version, happy to send it to folks.
Like that. Thank you, John. And we've got a short window left. Anya, I'll let you quickly jump in and have the last word here, and then I'll thank you all.
I think I would agree with both Bill and John. Look, so I think we're trying to lean into the larger macro themes. So whether that's a need for cheaper healthcare, we're offering better access, whether that's anything around energy tied to both the increased use of AI, but even without AI, our huge energy needs for storage, the data center needs, etc. So I think we're very cognizant of the larger sort of themes happening and the larger trends and trying to marry them up with the investment opportunities, but very much also looking at the granular. So looking for those managers who have the expertise to actually execute on those themes, not just the marketing stories, but actually the expertise behind them to execute.
Let's hope that we can continue to find those managers. Look, I want to thank you all for your candor, your straightforwardness, your corrections where they were necessary. You're a great group, and very much appreciate your time. And thanks also to everyone for joining in and listening in, and for your questions. Really appreciate it. So I think nothing left to say but to wish everyone a good day, and look forward to seeing many of you soon, I hope. Take care. Bye bye.
Thank you.
Thanks, Etienne.
Thank you. Bye bye.
Thank you.